Howdy, y'all. Welcome to Liberty Call. Today is Tuesday, September 26, 2023. I am Raymond Dolman, your humble host here at the Liberty Call. Glad you're here. It is a beautiful day here in Colorado. There is not a sign of clouds in the sky. It is sunny and 75 degrees. Again, those 80-degree days are in the rearview mirror if you live here in Colorado. So if you're down in Texas, I feel bad for you. But, love my Texans, but that heat down in Houston is just awful. Anyways, like I said, hope everybody's having a good day out there. The Astros actually won a game last night. It was kind of shocking. I don't want to jinx it too much, because I talked about it a lot yesterday, but fingers crossed. So anyways, all right. Well, if it's your first time watching Liberty Call, I'm glad you're here. Thank you very much. If you could do me one favor, one thing only, press the subscribe button and maybe the like, share, subscribe, all those things, and hit the notification bell because you want to know when I go live, because you don't want to miss out on all this genius that I'm sharing with everybody. So, all right, let's go ahead and get into the numbers for today. Dow Jones was down 1.14%, 388 points. I remember that used to be a big number for the markets, and now it's only 1% for the Dow. It closed at 33,618. The S&P 500 was down 1.46%, closed at 4274. NASDAQ down 1.57%, closed at 13,063. The VIX was up 12.07% today. It's currently at 1894. And for those out there who are not familiar with what the VIX is the volatility index, and it's usually based upon the S&P 500. So when the VIX goes up, that means volatility is going up and bad things are usually going to happen. So how I kind of view that is anything below 20 on the VIX, you're fine. 20 to 30, that's like your yellow light when you're heading up to an intersection. And anything over 30 in the VIX, proceed with caution. I mean, you're welcome to, stop, look both ways, and then, go ahead. But, if you get hit by a T-boned by an 18-wheeler, not my problem. So anyways, all right, back to the numbers. Let's see here. Canada was down 1.23%. Brazil was down 1.42%, and Mexico down 0.5%. Our European friends, Germany was down 0.97. The UK was flat, up 0.02. France down 0.7. Let's see, Netherlands down 0.72. Spain down 0.2. Italy down 1% flat. Let's see here. Switzerland down 0.55 and Portugal down 0.29. I know, Jake, it's upsetting. Russian exchanges, the MOEX was up 0.21. RTSI up 0.14. And the overnights, the Nikkei in Japan was down 1.06%, Australia down 0.54%, New Zealand down 0.81%. In China, the Shanghai was down 0.43%, the Shenzhen Component down 0.6%, China 50 down 0.77%, DJ Shanghai down 0.44%, Hang Seng down 1.43%, and the Taiwan weighted, was not open. So that's why it hadn't changed since yesterday. Yeah, the markets were angry today. Whew. Somebody pissed them off. So probably because the Fed didn't lower interest rates last week, and yes, they paused, and I think most people, that's what they were crossing their fingers and hoping for. But I think they were hoping for some guidance that the Fed was going to be like, yeah, you know what? We've had rates far too high for far too long. Let's go back down to like 2. I mean, if you're getting a mortgage, that's great, but at the same time, it's killing the economy. So, all right, let's get to our market recap. S&P 500 slumps to more than 3-month low as tech slides as rates bite. All right, the S&P 500 experienced a significant decline, reaching a more than 3-month low on Tuesday. This decline was fueled by weaker consumer confidence data, sparking concerns about the state of the economy, especially as consumers face the prospect of higher interest rates and inflation. Who would have thought? I know. You just can't print $5 trillion and have no inflation. It's weird. The consumer confidence index dropped more than anticipated, falling to a reading of 103 even, marking a 4-month low. This decline raised worries that consumers might be feeling the pressure from combined effects of rising inflation and interest rates. Really? People are just now starting to feel inflation? I mean, I've been feeling it for 3 years now. I mean, things at the grocery store started going up in 21, and everybody's like, oh no, it's fine, it's transitory, it's no big deal. All right. Where were we? Shit. Consumers who have been a key driver of economic growth have been rattled by persistent price increases and concerns about the potential government shutdown. Yeah, I don't think anyone in America is worried about the government shutdown unless you're a federal parasite who's collecting a paycheck from the government. Dana Peterson, chief economist at the Conference Board in Washington, noted that write-in responses from consumers showed continued preoccupation with rising prices, particularly for groceries and gasoline. Yeah, because nobody eats or drives. Treasury yields remained at multi-year highs, with the 10-year yield hovering around 4.54%. This came after JP Morgan's Jamie Dimon warned that the Federal Reserve could raise rates as high as 7%. Oh, my Lord. Expressing uncertainty about whether the world was prepared for such a scenario, Dimon highlighted that the move from the current Fed funds rate of 5.4 to 7% would be more painful than the earlier increases from, say, 3 to 5. Tech stocks resumed their downward slide, with big tech companies like Alphabet, Microsoft, and Apple all experiencing declines. Investors continued to factor in the potential challenges for growth stocks under the backdrop of higher interest rates. The impact was particularly pronounced in sectors with higher price growth stocks, such as technology. Amazon faced additional headwinds as it dropped more than 3% following the Federal Trade Commission's filing of an antitrust lawsuit against the e-commerce giant. Well, it was up like 4% yesterday, so I think that's still coming out ahead. The FTC, joined by 17 state attorney generals, alleged that Amazon had engaged in anti-competitive and unfair practices to maintain an illegal monopoly. Amazon's general counsel refuted the allegations and expressed the company's intent to contest them in court. Well, what are the allegations? I'd be curious to see what those are. I haven't really seen any in-depth articles on that. If you see any out there, feel free to send them to me because I'm generally interested. I mean, I'm not a huge fan of Amazon. I use their services. It's, living out here in the sticks, it's nice to get your, things you forget at the store, they'll bring them to your house, which is nice. But yeah, I mean, is it anti-competitive? I don't know. All right. In Washington, lawmakers were working to prevent a government shutdown ahead of the October 1st deadline, which could lead to a cessation of non-essential federal operations, which is basically all of them. The Senate planned to vote on a bill to extend government funding for 45 days, with the outcome pending in the House of Representatives. I know Matt Gaetz has been one who's been really pushing for single item bills as far as spending. None of these omnibus things. He was on Tim Pool the other day and he was talking about it. So, I mean, he's kind of, they're all skeezy, but I mean, at least he's, pushing for the right things, in my opinion. The Senate planned to vote on a bill to extend government funding for 45 days with the outcome. Oh, yeah, we were with that. However, the bill's passage in the House was uncertain as some conservative lawmakers were opposed to a short-term funding extension. Yeah, good. I mean, they've been kicking the can since the 90s with these CRs, continuing resolutions, just, we'll just keep things the way they are, just grow it by 2 or 3%, whatever the cost of living is. And, but they've been doing it for all these years. I mean, look, we're overspending by $1 trillion, $2 trillion a year. And the national debt went from 33 trillion to 33.1 trillion in like a couple of weeks. I mean, that's, it went up 1/10 of a trillion in a couple of weeks. I mean, that's insane. So anyways. All right, next up, this comes from Zero Hedge, The Looming Economic Cauldron, and this was authored by Stephen Cortez of American Greatness. So let me get to my summary here. All right, the current economic landscape in the United States is riddled with unprecedented challenges and contradictions, posing substantial risks to the prosperity of the American people, particularly those with modest means. These economic conundrums have arisen as a result of a series of mistakes made during the COVID-19 pandemic, compounded by policy decisions and actions taken by President Biden and Trump. He's equally as responsible for this mess, and his collaborators among Republicans. 3 key conundrums are shaping this economic landscape. The first, and we'll right here, interest rates surging amidst economic slowdown. The Federal Reserve recently created market turbulence by emphasizing the need for prolonged higher interest rates to combat stubborn inflation. Typically, rising interest rates correspond to periods of robust economic growth and high loan demand. However, the current situation deviates from the norm, with economic indicators signaling a slowdown. For instance, the ISM PMI has remained in contraction mode for 10 consecutive months, indicating a recessionary trend. Number 2, where is it? Soaring energy prices despite global economic deceleration. Traditionally, China has played a pivotal role in influencing global oil prices due to its heavy reliance on petroleum and the United States. However, a new phenomenon has emerged as crude oil prices surged dramatically while China's economic outlook deteriorated. This divergence suggests that inflation triggered by the 2020 fiscal stimulus, along with restrictive energy policies implemented by the Biden administration, has contributed to elevated oil prices. Who would have thought? I mean, there's still like 100 plus more rigs that are still offline, but we're pumping about the same or nearly the same as we were 4 years ago. So it's, I don't know. Number 3, what is that? What's the last one here? Housing prices remain high amidst plummeting mortgage demand. Despite skyrocketing interest rates and a strained consumer, housing prices have remained elevated. Mortgage demand, on the other hand, has witnessed a significant decline, with mortgage applications reaching their lowest levels since 1996. This perplexing scenario has led to a housing affordability crisis. These intertwined economic challenges have created a cauldron of economic instability. The fiscal deficit has doubled compared to the previous year, raising concerns about the sustainability of financing this ballooning debt and the long-term consequences for future generations. I mean, and I do remember President Brandon last year, patting himself on the back saying, yeah, we reduced the deficit from this to this. Well, that was because you had all that stupid COVID spending in the previous years that when it rolled off, it made it look like the deficit shrank, which it didn't. They were still overspending. All right. Furthermore, the divergence between surging oil prices and we already read that. To address these economic conundrums, the nation needs to prioritize fiscal responsibility, which I don't think will happen, unleash domestic energy production, which, with the blue people in charge, I don't think that's going to happen either. Remove obstacles to housing construction. That's more of a local issue, and strengthen border security to enhance the earning potential of American citizens. Really, as they're letting people in and advocating for letting them have work visas immediately, because that's what Kathy Hochul was saying in New York last week. So I guess unemployment in New York has reached 0 since they have to have all the wetbacks come in and do the work that the New Yorkers won't do. So anyways, all right, well, that's that. It's not good. So last up, this comes from the Mises Wire. It's titled, The Fed Holds the Fed Funds Rate Steady Because It Doesn't Know What Else to Do. This is written by Ryan McMacken. He's a smart guy. So let's see what he had to say. All right. The Federal Reserve's Federal Open Market Committee has chosen to keep the target policy interest rate, the federal funds rate, unchanged at 5.5%. This decision reflects the FOMC's belief that the current rate is sufficient to control the persistently high price inflation that has exceeded the Fed's 2% inflation target since mid of 2021. The FOMC's press release largely echoed previous meetings, emphasizing solid economic expansion, albeit with some indicators suggesting a slowdown. While job gains have slowed in recent months, they remain strong, and the unemployment rate remains low. However, inflation remains elevated, which is a cause for concern. The U.S. banking system is considered sound and resilient, baby. And the committee plans to continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities. The FOMC's assessment of the economy, particularly regarding labor demand, has been criticized for cherry-picking indicators that present a more optimistic view of the economy than what some believe is warranted. This focus on current jobs may obscure a broader and more accurate picture of the economic conditions. Federal Reserve Chair Jerome Powell acknowledged that inflation remains well above the Fed's long-term goal of 2%, and that the process of bringing it down to that level is far from complete. The FOMC meeting has been labeled as hawkish, and that's in quotes, by market observers because the summary of economic projections suggests that the target inflation rate will likely remain at or above 5.5% for the rest of the year. Powell's comments indicated that the median projection for the appropriate federal funds rate at the end of the year is 5.6%, followed by 5.1% at the end of next year, 2024, and 3.9% at the end of 25. So by the 2 years from now, it's still going to be at 4. So, and that's their projection. So, and these folks are usually wrong. However, there are concerns that the Fed's optimism about reining in inflation may be overly hopeful. Some believe that the central bank's inability to accurately predict inflation in recent years raises doubts about its ability to manage the situation effectively. The Fed's reliance on maintaining the target interest rate may not be sufficient to control inflation, especially given the historical aberration of ultra-low rates that persisted for over a decade. I've talked about that till I've been blue in the face, sometimes red. The ongoing debate revolves around whether the current target rate is indeed the correct level, as the Fed's interventions make it challenging to determine the market's natural interest rate. The Fed's decision to pause rate hikes has raised questions about its willingness to follow through with its tightening, as historical experience suggests that once the Fed pauses, it rarely resumes a sustained period of monetary tightening. And a lot of times it does what they call the Fed put, which is when the stock market starts to have a lot of problems, they slash rates, create a lot of money, throw it at the problem, and hope for the best. In conclusion, while the Fed has paused rate hikes to rein in inflation, there are doubts about whether this approach will prove effective, and the central bank's future actions remain uncertain. Political considerations may also influence the Fed's decision as it seeks to balance inflation control without causing significant increases in unemployment. Well, I think that's already baked in at some point in the future. Alrighty, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.